Marc Faber, the editor of the Gloom, Bloom, and Doom Report, joins us on the program. And Marc, in a recent newsletter, you talked about getting together with some prominent economists, many of whom have been lifelong friends of yours, such as Gary Schilling, David Rosenberg. Now, those two were deflationists. Two of you at the get-together were in the inflation camp, yourself and Ed Yardeni. I've always found it amazing how economists can look at the same data and come to opposite conclusions. Marc, what is it in your backgrounds and line of thinking makes you come to different conclusions?
Yeah, that's a good question. I mean, I think the deflationists, they also have families. They go shopping, their families go shopping, they pay educational costs, they pay healthcare costs, insurance costs, and they see the fees on local government services increasing, taxes generally increases, then I find it hard to believe that they would endorse the concept of deflation. But obviously they may think that the economy may collapse and that as a result of that we may have deflation and that therefore you should buy long-term U.S. government bonds. And my view is, particularly in the deflationist scenario, where you would have, like Prechter says, a Dow Jones below 1,000, in that scenario, you wouldn't want to be in U.S. government bonds and in cash for the simple reason that in that scenario, the fiscal deficit, in other words, spending, would exceed tax revenues even more than if you are actually optimistic about the economy. Just consider, if the Dow Jones went below 1,000, what kind of an economic environment would we be in? We would be in a total credit collapse. We would be in a total economic collapse. And we would have a complete corporate profit collapse. And in a corporate profit collapse and in an economic depression, what do you think would happen to tax revenues? They would collapse as well. And so the revenues of the Treasury would decline very meaningfully, and the fiscal deficit, which is now running, say, optimistically said, at $1.5 trillion, if you counted the unfunded liabilities that are accruing every year, probably the fiscal deficit is more like $2 to $2.5 trillion. But let's say $1.5 trillion. If that happens, the Dow Jones below 1,000, corporate profits collapsing and revenues collapsing, then the fiscal deficit for sure would be $2 to $3 trillion. And in that environment, the quality of credit of the U.S., as was suggested by Moody's yesterday, would decline, and U.S. government bonds, which I think are already today junk bonds, would go and yield much more than less than 3% of what they're yielding at the present time. So particularly in the deflationist scenario, you don't want to be in government bonds.
You know, I was reading that you got your Ph.D., I think it was at the age of 24, if I'm correct. How would you contrast the world as it existed back then, Marc, when you got your degree, and the world today as it exists, and more importantly, working in the real world and running your own business? Do you have a different view now of how the world works versus your days in academia?
Well, first of all, I grew up in the 50s and 60s. I was born in 46, so in the late 50s I was, say, 12 to 14 years old. And I have to say, in general, we were much more free than we are today. We had much more freedom to do things and to do stupid things. Today, everything is controlled, not only in the U.S., but also in Europe. States have become police states where everything is controlled and checked upon, either by the police or the IRS or by the TSA or whatever it is. But you are restricted in every movement you make, basically. Secondly, at the time I grew up, we still had fixed exchange rate. We had Bretton Woods, in other words, the quasi-gold standard, which no longer exists today. And the ability to print money today and to run huge trade and current account deficits is much higher today than it was at that time. In 1971, under President Nixon, on August 26th, the U.S. went off the gold standard, and that led then to the inflation of the 70s and the gold price rising from $30 to $850.
I want to come back to your recent newsletter where you emphasized the very thing you just mentioned, that the importance of having economic choices and the importance that those choices play or contribute to one's personal happiness. I had a recent conversation with a friend of ours, and we had a discussion on those choices are being limited, especially here in the U.S. And one thing that we were talking about, Mark, and you've commented on this in the past, in the U.S., we are seeing wealth disparity is growing, where wealth appreciation is occurring at the upper income levels, while at the lower end, debt has exploded. So you have a wealthy person who has probably a lot more freedom of choice, and then you contrast that with a person that's living on entitlements who has no choice but to vote for a political party that will guarantee the continued payment of those entitlements. Mark, the disparity of wealth in the U.S. has never been larger, and a lot of this, I think, has a result of the Fed's reckless money printing propensity. Now politicians want to tax the rich more because they are holding the majority of the country's assets. If you were president of the United States, how would you rectify this wealth imbalance without jeopardizing the country's growth prospects?
Well, I think that, if I look at a country like Singapore that was really very poor in the 70s and how they became affluent, or Taiwan or South Korea, it's usually a long process. I mean, it can't be turned around in 3 days or in 3 years. And I think in the U.S., instead of wasting huge money on entitlements, what I would do is to implement an educational system where people with less means, in other words, lower income groups, have the opportunity actually to go to very good schools. That implementation, how it's done, probably the best it's done through the private sector with subsidies and not through the government sector. But it has to work through the government in cases where countries are relatively small. In other words, that would imply that the educational system is a municipal or state affair, because in small countries like Norway, Finland, Holland, the Netherlands, in other words, and also in Denmark, the educational system is of very high standards, and people actually pay very high taxes for it, but they also get something back for it. Equally, they pay very high taxes and they get first-class medical care. So it works in some cases. In other cases, where countries are very large, where there is a lot of abuse, where there is less sense of nationalism and a club mentality, it works less well.
Yesterday, before Congress, Congressman Paul pointedly asked the Fed chairman if he believed gold to be money. After a pregnant pause, Mark, Bernanke stated no, but then elaborated by saying that gold wasn't money in the same sense that treasury bills aren't money. How do you explain this convoluted logic, a debt instrument versus an asset?
What is money? That's already a big question, because, say, if I go out tonight and I have no cash in my wallet, but I have a credit balance, say, of $1 million at American Express or MasterCard, with a credit card, I have money. proviso is, of course, that someone accepts the credit card, that it works that particular night. So in that sense, it's difficult to define precisely what is money. But I would say the general accepted definition of money is that money is a medium of exchange. In other words, you can exchange goods and services for what you have, that it is a store of value, and that it is a unit of account. And so if we look at these three attributes of money, then I would say as a store of value, of course, gold is much better at the present time than a US dollar or any other paper currency. Secondly, as a unit of account, say the US says we've been growing at 3% in real terms for the last 10 or 20 years. I'm not sure that this is true, because if I adjust the US dollar for its depreciation against, say, a unit of account that is relatively stable like gold, then I could argue, well, actually the US economy in dollar terms has been expanding by 3% per annum, but in real terms, in true real terms, not in real terms as measured by American statisticians that rely on Bureau of Labor Statistics inflationary figures. If I measure it in true real terms, then I could say the US GDP has actually contracted, which may not be correct, but for sure, the standards of living of the typical household, and I'm not speaking here of the partners of Goldman Sachs, I'm speaking here of the typical household, has gone down in the last 20 years. And I would even venture to say that relative to the rest of the world, the peak of US prosperity occurred sometimes in the 1950s. Because at that time, countries like Brazil, China, India, even the European countries, they were dirt poor because the European countries had suffered from World War II much more than the United States. The US, to some extent, benefited from World War II. So my argument is simply, it's very difficult to measure economic growth, very difficult to measure prosperity, but all I can say, when I started to travel the world in the 70s, and I went to, say, Latin American countries, to Eastern Europe countries, to Asian countries, all these countries were way behind the US, way behind the US in every respect. And today, the infrastructure in most of these countries is actually better than in New York, Los Angeles, San Francisco. Also, it's natural because these countries put their infrastructure in the last 10, 20 years, whereas the US, and that is another problem that nobody or very few people talk about. The problem of the US is that they grossly neglected their infrastructure for the last 20 years. In other words, they have the same trains that run on the same rail track and that haven't been modernized by and large. They have the same subways than they had 50 years ago and so forth. And much too little as a percent of the economy has been invested. It's all been spent, consumption, and that doesn't create wealth. What you consume, what you eat is gone. What you use in gasoline and burn is gone unless it's used for running factories that produce something. So basically the US economic policies, it's not just monetary policies, but the entire economic policies have been to perpetuate an American dream and live beyond means for the last 20 to 30 years. And that's just not realistic because it was built on borrowing more and more to offset the declining incomes in real terms, in other words, inflation-adjusted terms. And now the power to borrow more is gone.
In a recent issue, and this relates to our infrastructure here, in the Gloom, Boom, and Doom report, I see that you traveled recently to the Gold Coast of Southern California, where I live, including Newport Beach and Laguna Beach. I think, Mark, what distinguishes you from a lot of economists that I read is that when you travel, you actually do your own research by talking to real people with real jobs. And you noted that Californians universally complained about the strict regulations and burdens imposed by our state, and that seems to be getting worse. But what I want to know is, when you travel throughout the world, Asia, and mingle with people there, what is it that they complain about or fear the most?
Well, in general, I think that when I look at Europeans and Americans, they basically complain about more and more regulation, and that is one of the problems. You have, on the one hand, easy money, in other words, money printing, expansionary monetary policies, and in theory, what Keynesian would call expansionary fiscal policies. In other words, the government takes a larger and larger role in the economy, which I think is actually strangling the economy, not proactively promoting economic growth. But at the same time, you have more and more regulation whereby especially small businessmen that can't afford an army of lawyers and accountants and auditors to bypass regulations and avoid taxation like the big corporations such as News Corp and GE can do. These people have no appetite whatsoever to hire more people. Zero appetite. They say, I rather earn a little bit less and have less headache with the government, because they argue the more tax we pay, the more the government will harass us. And in Asia, there's a different view of the world. You have essentially people that were extremely poor, particularly in countries like India and China, where 20 years ago, nobody dreamt that he would ever travel, that he would ever have a car or a motorcycle or a house. All these people have it now or are getting it. And so there's a much more upbeat atmosphere. It's like when you are a sportsman. As you improve, as you beat your competition and you improve in your rankings, you are upbeat, you're optimistic. Once you reach the peak, like a Federer, and then you start to go down because it's not that your talent goes down necessarily, but others are getting better. Obviously, it's an atmosphere that is totally different. It's a deficit atmosphere, and this is what is engulfing the Western world. Most people in the Western world, they think that their children will not live the same living standards like they lived, and they start to think that their living standard is not the same than their parents' living standard was.
Just as an aside, by the way, what did you find most alluring about Southern California from your travels here?
It's a gold mine. The girls are very friendly. In general, people are very friendly. I mean, everybody talks to each other. I have to say, this is still a great quality of the U.S. If you go to the Midwest, or you go to the South, or you go to Southern California, people talk to each other in a pub, and they enjoy each other's company, and I mean, it's a very nice atmosphere, and that you don't find in many other countries to the same extent.
Oh, I thought you might have said it was our picturesque landscape.
Well, the landscape is particularly picturesque in terms of females.
I want to come back to our discussion here on Asia. Do you find it ironic that the East is becoming more capitalistic while the Free West is becoming more socialistic? And carrying that one step further, Mark, can you foresee a day when the East actually becomes more democratic than the West?
Well, I mean, we have in the East not true democracies, but for some funny reason, we have a lot of economic freedom. It's just that you have to be careful not to step on the government's toes in terms of criticizing them too much. I mean, the way I criticize Mr. Bernanke and the way I criticize Mr. Obama, for sure, I couldn't do in China. For sure. And it would be viewed very negatively if, say, I live in Thailand and I'm not here frequently. But if I went really after the government here, I think I would have to be somewhat careful. And this is still a great quality of the U.S. No matter what you say against American leaders, whether it was Mr. Bush or Mr. Obama, criticism is still accepted.
You know, I have heard you say countless times that you know that the Fed will print, and print more. In fact, if we take the recent Fed minutes released this week and Mr. Bernanke's testimony this week, it would imply that more printing is on the way. With the help of Bernanke, many of your rather prescient calls have been realized, but not quite all of them. You were one of the first, to my knowledge, to predict the possibility of a hyperinflation in the U.S., and that may seem hard to believe for many Americans. Mark, if you were to take that hyperinflation scenario and put it on a scale of 0 to 100, with 100 being the most probable, how would you rate the chances of hyperinflation here if we continue to do what we're doing?
Well, actually, it hasn't happened yet, but you understand, hyperinflation is an inflation that gets out of hand after a period of relative calm. I mean, in Germany, prices started to increase in, say, in the hyperinflation in 1918, after the war, 1919, and they only really exploded on the upside in 22-23. And the same happened in Argentina, in Latin America. So I'm still wondering whether it can happen. And I happen to think that the likelihood has actually increased for the following reason. You know, if you go back to, say, January 1st, 2011, we were all celebrating New Year, and a week earlier we had Christmas. Who would have thought that the Middle East was in the process of blowing up? Who would have thought that NATO countries that are bankrupt, like Italy, and not in a much better position like France, would go to war against an idiot in Libya? I'm not saying he's a nice person. I'm saying he's an unpleasant character. But if you went after all the unpleasant characters in the world, you would have to go after like 180 countries. So, I mean, he isn't worse than the other ones. There's no reason to be in Libya, no reason whatsoever. It's a complete madness to fight in Libya, and if you fight, you have to fight to win. But I haven't won in 3 months. He's a man alone. He's going to be a hero of the revolution to stand up. Whatever he dies of, and eventually he'll be removed. But he's a hero of the revolution, a man alone standing up against the imperialistic, capitalistic, colonialist Western world. And I think what will happen eventually is the U.S., if you read papers in the U.S. and studies, it's all about how do we contain China. The Western world knows, including Western Europe and the U.S., one way to control China is to control the oil in the Middle East. And if they control the oil in the Middle East, they can switch on the tap or close the tap to China, because China, Japan, Taiwan, South Korea, Hong Kong, they get 95% of the oil from the Middle East. That is not the case for the U.S. The largest supplier of oil to the U.S. is Canada. And there's a large supplier is also Mexico and Venezuela and East Africa, Angola, Nigeria. The Chinese are 100% dependent on Middle Eastern oil. And the U.S. and Western powers, they will go and destabilize the Middle East and then try to control it. Well, obviously, they can only go this far because, first of all, it will take a lot of money. Say now they are engaged in Libya, they're engaged in Iraq, they're engaged in Afghanistan. Next station, they have to be engaged in Pakistan, which is gradually shifting its alliance to China away from the U.S. Now, when the U.S. went into World War II, debt to GDP was 140%, and they didn't have unfunded liabilities for Medicare, Medicaid, and Medicare. Now, they have the unfunded liabilities, and they have debt to GDP of 379% officially. But with the unfunded liabilities, something like 800%. They're not in a position to finance the war unless they print money. And so I think the geopolitical picture will eventually lead, in my opinion, to much higher inflation rates than what we're seeing now. And by the way, I think the inflation in the U.S. is already much higher than what is being published by the media. And we know now about the media, since Mr. Murdoch is the largest media magnate, and since he, for sure, because I know some people who used to be in leading positions at News Corp in Asia, he calls them every day. He checks everything that they do. He knew about the hacking in Britain, for sure, and he sanctioned it. But this is big business. Big business is dirty. But why is it dirty? Because it's been made dirty by the government.
Speaking of this hyperinflation scenario, and we're hearing more evidence and reading more evidence that the Fed is going to print more money, but when they print money, Mark, they can't always direct where that money flows. Recent money creation helped to inflate stock prices. You have gone on record, and you believe that the U.S. stock market has topped out in this year. On the other hand, Mr. Bernanke is ready to print money again. If he continues to print money, I guess, would you retract that statement about the market top? Or do you think that the money is more likely to flow in some asset category that we can't quite predict at this moment?
Yeah, this is a very good point. And I'd just like to mention that I frequently criticize Mr. Bernanke, but the true reason I really criticize him is that he has maybe some knowledge about economic expansion and contraction and booms and busts in a closed system. But he has no clue whatsoever about international economics. Because if you look at the last 10 years of economic development in the world, the U.S. went into a boom that created the NASDAQ boom, money printing following the bailout of LTCM, money printing ahead of Y2K, and then the NASDAQ bubble burst, and then more money printing that then produced the credit bubble and the housing bubble and so forth. But where the money really went to in terms of investments and production and wage gains and increased consumption was actually in Asia, where as a result of the U.S. trade deficit, countries had a huge trade surplus, which boosted economic activity. And so what you said is absolutely correct. We can drop as many dollar bills onto the United States, but we don't know where the money will flow to. It flowed into the NASDAQ until March 2000. Then it flowed into the housing market until 2006, 2007. But basically where economic activity was occurring and boosted was outside the U.S. And the more the U.S. will print money, the more, in my opinion, the dollar will depreciate against some currencies. Maybe not all, because, say, the euro is certainly not more desirable than the U.S. dollar. But it will continue to depreciate against strong currencies like gold and silver, platinum, and probably palladium. I mean, I feel sorry for Mr. Bernanke because he really doesn't get it. He doesn't understand. He's a typical academic. You know, a typical academic is a professor in medicine that knows everything about how a patient becomes sick, but doesn't know how to cut something like a butcher and therefore can't operate on a patient. Mr. Bernanke academically knows everything, but has no clue about the real world. No clue whatsoever.
This brings up a point. Listeners to my show already know that they should own gold and silver. I've been telling them that for about 10 years. What I find fascinating, Mark, in many of the investment conferences that you speak at around the globe, when you ask how many of the attendees own gold or own more than 5% of gold in their portfolio, very few people raise their hands. And the only conclusion I can draw from listening to this or reading this is that worldwide investors are grossly underweight gold, and that would imply to me that precious metals, and especially given the fact that we're more likely to print more money, have much further to run.
Yes, first of all, I have to make an observation. A bubble occurs after several years of price increases, like the Nasdaq performed well between 1990 and 1998, and then it went ballistic, and between August 99 and March 2000, the Nasdaq doubled. In other words, at the tail end of a trend, you get an annual appreciation of a market, whether it's cotton recently or whether it was the Nasdaq or housing, that almost goes vertically. The Nikkei had a similar type of pattern. At the end of the bull market in the 1980s, the Nikkei went up at an annual rate of, 70% or so. And this hasn't happened in the gold market. And I tell you, since I have a website, gloomboomdoom.com, and a newsletter, from my readers' inquiries, my sense is that most people have actually already sold their gold. Because there were continuously people that told investors, gold has topped out, it will go down. Then there were clowns that told them that gold was a bubble. Recently, about a month ago, there was even a Fed member, a governor of the Federal Reserve, that said, if I had any money, I would short gold. My comment to that is, if you're a Fed governor and you have no money at all, then something is wrong with you in the first place. You shouldn't be a Fed governor. Secondly, I wished he had borrowed money and shorted it, because since then it's up like $100 an ounce. So I agree with you. I was at the resource conference. This is one of the largest resource conferences run by Standard Chartered Bank in Hong Kong. All the miners are there and all the big shots in the commodity space, and investors that are interested in commodities are there. Ask the audience, and you would think that these people have an exposure to gold. Only about 5 people in an audience of like 400 have more than 5% of their assets in gold. I find this amazing. I was already at 2 hedge fund conferences. These are relatively intelligent people, you would think. But none of them had any exposure to gold personally. I said to them, you're all intelligent people. How can you not have any gold at all? Don't you see what is happening with the money printing in the world? People, they look at gold. Okay, it was $252 in 1999. It's now $1,580. They think it's expensive at this level. What they don't consider is by how much credit has increased over the last 10 years, by how much the world's population has increased over the last 10 years, by how much the supply of gold has increased. It's not increasing, it's actually contracting. In the next 5 to 10 years, the total gold supply in the world will go up by precisely 3.8%. No more. You know, you mine something, it's gone, it's no longer there. And so the supply is no longer there. It's like oil. You burn it, it's no longer there. So every oil well runs dry over time.
Looking out over the next 10 years, I think it would be safe to assume that it's going to cost us more to live, no matter whether it's energy, food, etc. Looking at the investment markets, Mark, I know you stress the importance of diversification, but if you had to choose only one investment and you could not change that investment for the next 10 years, what would that investment be?
Well, basically, I mean, I would say we look at different asset classes. So we have cash, we have government bonds, we have corporate bonds, we have real estate, we have equities, and we have commodities and precious metals. And so the question is, you know, where do you put your money? If you and I go away to an island or to jail for 10 years and we can't make any transactions and we come back in 10 years' time, I think if the objective is the maintenance of purchasing power, in other words, you just don't want to wake up in 10 years' time when you come out of jail and what you have is worthless, then I would say that probably gold is the best alternative. If the question is, how do you maximize profit? Probably there may be more profits in equities because, you know, we had the dismal performance of equities in the last 10 years. And particularly in the U.S., as a result of the decline in the value of the U.S. dollar, equities would seem to me to be not particularly expensive. I think what would be dangerous for you and me would be to put all our money in U.S. dollar cash and in U.S. government bonds for 10 years and then come back and maybe find out that we can buy with $100,000 just a cup of coffee, or not even that.
You know, I've often heard you advise your readers to diversify their assets, not just by asset class, but also by geographic location. Would you be kind enough to describe just what it is that you exactly foresee? In other words, just what is the end game in your opinion?
Well, basically, I mean, since I traveled a lot, I've seen people in Australia. They were Jews. They came from Eastern Europe. They arrived in the course of World War II or just after the war with nothing at all, and then they made money in Australia. But the ones that arrived with some capital, they had an advantage. I've seen the Chinese. I had a friend. He was working for a client of mine, and this client of mine was one of the richest Chinese in Hong Kong because his father had been a comprador for Jardines, and he had been a general in the army of Chiang Kai-shek in charge of supplies. The supplies generals, they make a lot of money because by procuring goods, you get a big cut. In any event, my friend's family in Shanghai had been much richer than his boss's family at that time, but all their assets were in China. And when the communists came in, they lost everything. Everything. And another friend of mine, he came in 1975 to see me in Hong Kong. He was working for the family in Vietnam, in Saigon. It was the richest family in Saigon. They owned the real estate on, say, the Prime Street in Saigon, which would be the equivalent of Park Avenue or Madison Avenue in New York. The whole street they basically owned. He came to Hong Kong, and while he was in Hong Kong talking to me, Saigon fell. He lost everything. The family, luckily the father lived already in Hong Kong and had some money there, but I mean not much compared to what he had in Saigon. So all I'm saying, if you're prudent, you should have the custody of some of your assets in the U.S., some in Canada, some in Australia, some in Europe, and some in Asia, Singapore, or Hong Kong. But if you have it all in the U.S., I can tell you already today, it is extremely difficult for a U.S. citizen to open an account with a bank overseas, because most banks no longer take U.S. clients because of the new regulatory environment. So you have free exchange rates, you have free money flows, but in practice you already have implemented some foreign exchange controls.
Couple final questions, if I may. Something that has struck me about this environment and more recently, it seems that whenever you have money printing of any kind, it usually leads in one form or another not only to a bubble, Mark, but in fraud. For example, in the 1990s, we had the Bre-X scandal in which a penny stock, a gold mining company, claimed to have enormous reserves, which later proved to be falsified. Then in October of 2001, Enron was exposed for its off-balance sheet liabilities. Then, of course, we had recently the Bernie Madoff scandal. And now we have Sino-Forest, a widely touted and widely held Chinese forestry company, that it had investors such as the prominent hedge fund manager John Paulson. Is it my imagination, or does it seem like the number of scams has dramatically increased? And if so, Mark, how would you explain this?
Well, basically, easy monetary policies create greed and bubbles. And one of the symptoms of bubbles and manias, investment manias, is always the proliferation of fraud, embezzlement, and dishonest practices. And we had also in the U.S., basically, I would say Fannie Mae and Freddie Mac were a complete fraud. But of course, the government will never admit that. I think the U.S. government is a complete fraud, with the exception of some decent people. But by and large, it's a fraud. It's a Ponzi scheme. And in China, obviously, we have a country that is growing very rapidly. And it's caught the attention of the world and of relatively unsophisticated people, dentists, doctors, whatever it is, professionals. And I think we have to buy some Chinese companies because China is growing very rapidly. And so where there is demand, the supply comes in. A lot of fraud companies are listed in the U.S. and elsewhere, and then they basically are revealed as being fraudulent. This is only natural. But I would say when people discuss China, is it a bubble or not a bubble, the fact that there are so many fraud companies in China would point out to me or show me that there is a bubble, very clearly. Latest money printing by Bernanke has basically produced not necessarily a bubble in the U.S., but it's produced a weak U.S. dollar, which is a symptom of inflation, and it's produced bubbles elsewhere in the world.
A final question, and this brings it back to something that we have been discussing throughout our discussion this morning, and that is gold. I recently read a report where the average American has 90% of his assets, which includes his home, in U.S. dollars. We've heard on asset allocation, you will often hear, well, you should have at least 5% in gold. And as you have commented, it's hard to find people around the world that have 5% of their portfolio in gold. Given the probability that they will sacrifice the dollar with all this money printing, Mark, what do you think is a reasonable percentage to hold in gold given this macro environment and the fact that the U.S. has extended its spending, it's spread out in 3 countries with wars, it has unfunded entitlements, and the only way out that I see for these politicians is to print more money. So given these scenarios, what is a good percentage to have in gold to protect oneself, especially when so many Americans have their money all in dollars?
Well, I think it's a very good question. And in the course of my life, I think that if I followed what the Jews are doing, you're usually on the side of the winners in terms of money. They're very smart at making money. And I have numerous Jewish friends that have either like 80 or 100% of their money in gold, silver, or gold, silver mines, and so forth. And I have other Jewish friends that have between 30 and 50% of their money in gold and silver. So I personally have less. I have like now maybe 20% of my money in gold and silver and in mining stocks. But on any meaningful decline, say if gold, and we can't rule that out, and I'm saying that in every newsletter I write, a correction can occur that is meaningful. Like gold started its bull market in 1971, and it reached a peak in 74 of $197 an ounce, and then between December 74 and August 76, at the time the Dow Jones went up very strongly because Dow Jones bottomed out in the bear market of 73, 74 in December 74. But during that time of stocks going up 74 to 76, gold went down by more than 40%, from $197 an ounce to $104 an ounce. There's a big, big correction, but then gold went up 8 times. I'm saying, you buy gold today, I don't know, maybe it goes down $100, maybe it goes down $200. But looking at all the factors we discussed, I don't believe that we are in a bubble stage, because I lived through the last bubble in the late 70s. I can tell you, the whole world followed the gold market day and night and traded gold 24 hours a day, like the whole world traded NASDAQ stocks 24 hours a day in 99 and 2000. That hasn't happened yet. We don't have a heavy weighting. We don't have a heavy kind of euphoria about gold at all. I know so many people, they bought gold at, say, $300-400. Where it was at 1,000, they sold it. They sold it at 1,200. And as prices never really corrected, they never bought back. They never bought back. They're sitting there empty. And all I can say, the risk today as an investor is not to own gold, but it's not to own any gold. If you have no gold at all, I think you're taking a risk. And my advice is simply, every month you put some money aside and you buy a little bit of gold. Depending, if you're very rich, you buy every month a ton. If you're very poor, you buy every month an ounce or whatever it is, or a gram. But every month you accumulate. You don't worry about the price fluctuation. You just buy every month a little bit. And your grandchildren will be very happy about that, unless the U.S. government takes it away. That is a possibility with Mr. Bernanke. You just look at him. He's basically not a particularly honest character.
I couldn't agree more, Mark. Well, listen, as we close, I want you to give out your website in your newsletter, and I want to thank you. I always look forward, Mark, to reading your letter each month. It's not only sometimes entertaining, but it always makes me think. And I have learned an awful lot reading you over the years. So give out your website, if you would.
Well, Jim, it's very kind of you to say so, and I've learned from you a lot. And, I mean, we've been friends for a long time as well. We don't meet frequently because I travel a lot, so I have a very busy schedule, and you're also busy and this and that. But anyway, the website is gloomboomdoom.com.
And once again, gloomboomdoom.com. Mark, as always, it's a pleasure speaking with you, and thanks for coming on our program.
Well, thank you very much. And I wish you and all your listeners a very happy summer. And it's very important to laugh a lot in life. And I have to say, in Southern California, I was with a few friends, and we just giggled the whole time. We had a great time. And this is also the good, America, you can't say all is bad. The good parts of America, some people are very nice. Whenever I go, I was recently, actually, it's very funny. I was in America, I had to take 4 flights. All the 4 flights were delayed, and as a result, I missed 2 connections. So I had to sleep at the airport in Chicago, to sleep at the airport in Kennedy, in Jamaica. And there you go, and these are places that the airlines, they give you a hotel, of course not the luxurious Four Seasons type of hotel. But then you go to these local bars and so forth. It's very funny. You meet a lot of people and you see the true America, and all the people are very friendly and so forth. So it has many, many good sides, America. It's the government that is horrible, and in particular the present one.
Well, Marc, please come back and talk to us again, and come back and visit us here in Southern California. It's a great place to live.
Thank you very much.